the way to build wealth is to concentrate. All the billionaires you see around you only got there because they were concentrated. And Munger used to say there's very few times in your life that you're going to get a trip to the pie counter. And when you get a trip to the pie counter, you need to load up big time on the pie. You don't need to just take one bite of the pie. You need to load up because it's not going to happen that many times.
So I have a question more on your portfolio and how you. So I understand that you mentioned that for individual stocks you look at like the competitive mode and the business itself, but across your whole portfolio, how do you balance across all your investments? And I guess how do you manage risk across all your investments, considering that in very big multi-manager hedge funds now that drawdown is looked at quite closely for each like portfolio. So how do you manage across all your investments in a sense?
Yeah, that's a great question. And it's actually a dilemma we have faced recently in sort of an extreme way. So going back to our beloved Turkish REIT, we own a third of the business, but 20% of that business is in one fund. It's our offshore fund, which has about 400 odd million in assets. And so if we look at the 20% of, something north of a billion, more than half of that portfolio is a single Turkish stock. And we have another stock in Turkey, which has also gone up and also become sizable. I think that's like 17 or 18% of the portfolio. They're both very undervalued. So it doesn't really make sense to trim those. So we are talking about like kind of more than 2/3 of the portfolio in two businesses in Turkey. Then we have in the same fund a couple of bets in the coal business, which are around 15-20% of assets. So by the time you look at the two Turkish businesses and the two coal businesses, we are already at about 90+% of the portfolio. And most of my investors, individual high net worth families, we don't have really institutions and such. So what I told my investors is, I said, look, if you have an investment in this fund and the total amount you have invested in the fund is less than 1/5 of your total net worth, then if I were you, I would just do nothing. Just let it be. Because what that would mean is that on a look-through basis, no single investment in the fund is more than 10% of their net worth, which is pretty reasonable concentration. And I said that if it's more than 1/5, then you should trim. My recommendation would be that you should withdraw some of your holdings from that fund to bring it within that sort of a limit and invest it in something non-correlated. So I told them that I wasn't going to kind of adjust the portfolio. They needed to adjust on their end, knowing what concentrations we have. And we saw some investors act on that, which is good. And such, they've kind of, adjusted things to kind of bring it within what they feel comfortable with. And so we spend a lot of time now giving a lot of data and transparency to our investors on the degree of concentration and how they can mitigate some of it. And so it doesn't make sense for us to trim something that is sitting at less than half of liquidation value. That just doesn't make much sense to do, especially because good investment ideas are very rare and hard to find. And I take the example of the Walton family, Sam Walton. So Sam Walton, when Walmart had its IPO in 1970 or thereabouts, his family owned about 36% of Walmart at that time. And he had already well before the IPO, he had already transferred the shares to his kids. So basically when Sam Walton passed away, the shares were already in the hands of the next generation and they didn't have any taxes or anything to pay. It just passed on to the next generation, which is very efficient from an estate planning perspective. If we look at entire Walton family stake in Walmart today, it is actually higher than it was at the time of the IPO. The entire Walton family stake today is in the kind of low 40% range. So they've actually gone from kind of mid 30s to low 40s, right? And what that means is that probably the overwhelming portion of the net worth of that family is in a single stock. It's in a stock where Sam Walton hasn't been around running that place for more than 30 years. And there are no family members in senior positions at Walmart. And there's maybe just one or two of them on the board. So they don't have control from a board perspective. And basically, they're extremely concentrated. And so I told my investors that we are not founder or part of the management or on the board of the large position we have in Turkey of Resas, but I think of it as a family business. I think of it like Walmart. I think it's a very good business because I've watched it for 5 or 6 years. I think it's run by exceptional capital allocators, very good assets, very good capital allocation, and don't really see anything going on there that gives me a pause to do something else. And so the way to build wealth is to concentrate. All the billionaires you see around you only got there because they were concentrated. And like Munger used to say, there's very few times in your life that you're going to get a trip to the pie counter. And when you get a trip to the pie counter, you need to load up big time on the pie. You don't need to just take one bite of the pie. You need to load up because it's not going to happen that many times. I don't expect to ever find another stock at 3% of liquidation value in my lifetime. So that's the way it is. That's how we think about portfolio concentration, all that. We don't have any hedges or anything. We're not going to trim positions just because they get too large. Just like the Walton family has not trimmed because Walmart got too large. They've actually bought more stock since the IPO.